CNBC Africa's Svetlana Doneva met up with Charles Robertson, Global Chief Economist of Renaissance Capital, to discuss Africa's growth, oil, commodities and emerging markets. Let's take a look.
Well, I think we've seen something very similar happen across Sub-Sahara since 2000, similar to what happened in India after 1980. And you get this burst of growth that apparently comes from nowhere. In fact, I think there's a number of reasons to happen, but apparently comes from nowhere. And then you go into the 2010s for Sub-Sahara now, similar to the 1990s, which is still a good growth rate for India, but it's not an accelerating growth rate. It's a consolidating growth of around 5 to 6% a year.
Now, commodity prices, you're saying that we shouldn't overly rely on them for sub-Saharan African growth. Can I ask you to elaborate on that?
Well, leaving aside, we've seen the oil price plunge $50 in 5 months now, and that, I think, is part of the rolling over of the commodity story, that supply has now finally more than caught up with demand, and that supply is likely to be continuing to come on stream, both in oil, iron ore, other metals and a lot of the hard commodities. So I believe in cycles. I think cycles are what drives commodities, and you had 10, 15 years of upswing and we're now probably in a period of 5 years at least where prices are going to be lower than they were in the previous 5. So we can't rely on commodities giving the pool of capital needed to drive investment and growth.
Amongst the emerging markets, who are the biggest losers and who are the biggest winners when it comes to the lower oil price?
In emerging markets globally, we'd be talking Venezuela, Russia gets hit as well. Within Africa, Nigeria is the one which markets are focusing on the most. Actually not because Nigeria doesn't produce that much oil per person, but the budget is reliant on oil, and therefore the government has got a choice, either to see the currency weaken or to do massive fiscal cuts, and that's, or at least quite significant fiscal cuts, and that's difficult. Those budget spending cuts, particularly ahead of an election due in February, March next year, is a problem. So Nigeria's going to be hurt. Angola is going to be suffering, and Sudan, South Sudan could also be hit to some extent.
Okay. Now, in your presentation, you referred to how it is different this time when we're talking about investing in Africa, Africa's growth story. And one of the points that you raised is lower government debt, pretty much all around. Can I ask you to tell me a bit more about that?
In the 60s and 70s was the last time we saw a commodity upswing, similar to what we've had in the last 10, 15 years. Governments not only spent a lot of those commodity benefits, but they also borrowed on top of that, and often borrowed in terms of unproductive assets, or building new cities in some cases, steel factories, car factories, factories that weren't quite suitable for that stage of development at the time. What's different now is that for the last 10 years, debt now is much lower than it was a decade ago, since the debt forgiveness deals. Where governments have been investing, it's been into the infrastructure that's really needed, electricity, roads, ports, and that should be setting Africa up to be able to do more as a continent over the next few years, even without the commodity benefits that we've been having for the last 10, 15.
Another thing that should be setting Africa up is human resources. A third of children at this stage are in secondary school, which is expected to have quite a significant impact on GDP 30 years on.
Absolutely right. This is the work that we've been doing this year, has been looking back to the 70s, the 1990s, and arguing that unless you're educating nearly a third of the kids, your growth, your economy remains in absolute poverty 20 years later. There's a huge lag, but that has really changed over the last, particularly the last 20. There's less than 10 countries now across the continent which don't educate enough kids. And even 3 of those have got oil or gas, so I suspect they're going to get wealthier anyway, leaving just about 6 countries like Burkina Faso and Central African Republic and Somalia without the education, which I think means they don't have the human capital to make me confident in their future for the next 10, 20 years. But for the rest of the continent, it's a completely changed story. There is sufficient human capital.
At the same time, you have identified a potential break in Nigeria between North and South in terms of the education there.
This is the Nigerian data. It tells us that over 60% of the South, 60% of the kids are at secondary school. They have all of the means at their disposal now to see much higher growth, and the south is the commercial capital, and the south has the oil resources. The north, without oil, without the human capital, less than 20% of kids at secondary school in a lot of the areas where Boko Haram is strong. And that's not a coincidence. And so this north-south divide in Nigeria is, I think, a significant challenge for the government, and something which probably requires federal government to be doing more in terms of transferring resources, trying to encourage investment, and obviously, first and foremost, tackling the security situation.
Now, to finish off, we've spoken about commodity prices, spoken about oil, human resources. What does all of these factors together mean for attracting financing into sub-Saharan African projects going forward?
That in the 1970s, when you had the commodity upswing, but there was borrowing, and that borrowing was being put into unproductive assets by governments, there was no private sector investment, or none from foreign direct investment. In the 70s, no one was interested in investing in sub-Sahara, I think because the human capital wasn't there. That's very different now. We're getting 2, 3, 4% of GDP every year being put into sub-Sahara. We've got local pension funds in Ghana, Nigeria, Kenya. It's a pool of captive money that wasn't there before, but is now. We've got equity funds, frontier funds, Africa funds that 10, 20, 30 years ago didn't exist. If there may not have even been stock exchanges for them to invest in. And if there were, they weren't attracting foreign money. We've now got equity money, foreign direct investment, we've got local pension funds, and all of this cash is coming in and is available to help finance growth even when commodities are not providing that easy liquidity we've had for the last 15 years.
So what kind of GDP growth projections do you have for the region?
Well,
perhaps in a medium term and a long term?
We end up with, to be very unexciting, exactly where the IMF is, suggesting 5 to 6% growth. We're saying this is not the decade of an accelerating growth path this decade, and it wasn't in India at this stage in India's development either. What changes as we go into the 2020s, assuming the governments deliver on electricity, which is what President Jonathan's talked about in Nigeria, is what the Kenyan government's doing, assuming you continue to see the investment, often financed by China, into infrastructure, the scene should be set for growth to accelerate to 7-8% in the 2020s, and then heading towards 10% or more, possibly levels of growth we've never seen anywhere, as everybody gets caught up into the positive growth story. And Africa looks ever more competitive as a continent relative to Asia, Latin America, or Europe.
That is Charles Robertson, who's the Global Chief Economist of Renaissance Capital.